I set up the scenario for you. I'm an investor nationwide. I'm looking for non-performing notes to reperform them. I'm probably going to season it after it's reperformed and do some sort of partial and sell off at the end of it. I'm looking at a tape right now that are higher end assets. I know they're higher end assets as I go into it because, and I can look at it at a glance and understand that just by looking at the tape details and knowing that the average unpaid principal balance is at 679,000. I also know that they're a little higher end too, because over the 132 assets that we have, we're looking at an average or a weighted average FICO score of 607. Now, we do want our FICO scores to be 630 and above, but I'm pretty sure that there's quite a few in here that are above that 630 mark. We also, in some cases, we'll also have debt to income ratio. That becomes important, especially if we're looking to do any kind of seller financing or underwriting on this if we've ever take the property back. But that's not our strategy right now, so we're not too concerned with that at this point. And when I look at all of this information here, it's more about me understanding what's on the tape, not necessarily the individual assets as they stand. I do know that there's a total of 88 million on the tape, which means that there's some higher end, definitely higher end or higher priced, I should say, assets. Now, with that, I will say this: a lot of people always ask, how do you know where the pricing should be on these assets? Because they range all over. I've seen 30 cents on the dollar, 55 cents, 65. I've seen it all the way up to par for non-performing notes, believe it or not. In fact, this tape that we're looking at right now went for a very high, sold for a very high mark. But what I'm going to do is I'm just going to kind of ease into this and show you guys how we analyze assets given the information that was presented to us by the seller, which is, again, this information. I don't think you saw that when I brought it up before, but this is basically what a tape looks like when it comes from the seller. Now, there's not a whole lot of, yes.
Got a question that was asking, how did you quickly tell it was high end?
So if I come back to here and I look at the average UPB, I can see that average UPB, let me put on my highlighter here. Hopefully it's easier to see. Is that better? So this average UPB tells me that each asset is, on average, is around $680,000. There's going to be some that are lower and some that are higher, but on average, you're in that 680,000 range. If these were lower end assets, meaning they had a lot of hair on them, typically they're going to be around that $50,000 mark, $30,000 mark, $80,000 mark. Anything below 100,000 is probably going to have a little bit of hair on it, especially given the fact that those types of assets are coming from private equity funds, smaller banks that are trying to get rid of their bad inventory. Let's just say that. Not to say that those aren't good deals. You can still find good deals as long as you have the right strategy, but that's not what we're looking for here. We're looking for a specific strategy to move forward with these notes. Now, the other thing that's an indicator is the FICO score. Okay, and the FICO score in really bad assets, you're going to see that somewhere in the 500 range, anywhere from 500 to 600 or lower. In this case, it's 607, and I can guarantee that when you see anything in the 600s, you're going to have quite a few that are above that 630 mark. So again, that raises the value of these assets. And then also what we look at is the loan age. The loan age, if the average loan age is around 2 years, we know that it's a fairly new loan, but it is seasoned. They are seasoned. And because they're seasoned for 2 years, we have, and there's equity in it. If we look at, when we get into the tape and we look at the equity, you'll know that there is skin in the game basically for these borrowers to stay in their homes. And I'll show you that in a minute. So we also have another indicator here is the remaining term. Right here, the remaining term on average is 359, which basically tells us that we have full loans here. And the reason the average is 359, because I think there's some loan modifications in here that are at 480, which takes that average up. We also have delinquent payment averages here. So the average delinquencies is about 1 year. Again, those are going to vary, and we can identify some of the better ones once we get into the tape. But so we're going to dive right now into the tape. I'm not going to get too much more in depth about that or the calculations or how it's done. This is just something that we developed for us to identify very quickly what's on the tape. Now, when we get into the tape, what we've done is we've taken the information that's been provided from the seller, which is this information here, and we've translated it into our own format, which is this one. Now, you guys can do the same thing. You can take that information and put it into your own format and run the calculations however you want, but I'm going to tell you how we do it. And one of the things that we've done is we've developed our own calculations, which you guys probably will never see from us anyway, up here. And these are all like little macros or calculations that allow us to quickly calculate a column for a specific need. For example, if the seller didn't give us the next due date, we can easily calculate it just by clicking a button. And the formula is right here. And if we need to check it, we need to double check it or triple check it, we can do that to make sure that we're
Joe?
right on. Yes.
Got a hand up. Kenesha has a question, I believe. Got a hand up there.
Sure. Let's see.
No, she muted herself.
Oh, Kenesha, you there?
Hi, yeah, can you hear me?
Yes. How you doing?
Hey, I'm good. How are you?
Good, thank you.
Good. Okay, really quickly. I jumped in a few minutes late. On your previous screen where you had the abbreviations WA, what does the WA stand for? I know it's something average. What's the W?
It's weighted average.
Weighted average. Okay.
It's different. It's different from average in that it looks at the unpaid principal balance and weighs that number against the
actual number.
Yeah, whatever we're looking at, the DTI or the FICO or whatever it is.
Okay, got it. That was it. I just wanted to make sure I was clear on that. Okay.
Yeah, it's just a lot more accurate way to look at averages.
Okay, perfect. Thank you. Thanks, Rick, for calling me in.
Joe, Gary's got a question. He goes, was the pool bought as a whole, or was it cherry picked by multiple buyers?
This one was bought by a single buyer, but it was offered out as a cherry pick tape.
It was offered at a very high.
Yeah.
Anyway.
So what I was saying is that when we take the information in here, we want to look at just about everything. All this information is very important to us. You know, our first pay date, our next due, our paid through, our maturity. We want to have this information. And if it's missing from the seller, we're going to ask for it, or we're going to calculate it on our own doing reverse calculations, which is what these buttons are up here. And I'm not going to get too much into that. If you guys are interested in some of those calculations or how to do them, you can email me and I'm very happy to share them. Very happy to, click on any one of these and you can see these calculations and how they're run. Some are very complicated, but if you know Excel and you understand how to use the formulas, then it should be fairly straightforward. So everything that you see in green are what we've calculated that the seller has not provided us. So right now you see a strike price in here, and that strike price is something that we've created based on a percentage of UPB that we enter. And that percentage of UPB that we enter, typically we're entering it here on this input sheet where we've created this tool for non-performing and sub-performing. So if I want to come in and I want to make an offer or start my offer at a specific rate, in this case, the non-performing starts at 65% of UPB, I can do that. Same thing with the sub-performing. And if we had performing or REO, I can put that in there as well, but we don't in this case. We only have non-performing and sub-performing. When I come back to the tape, all of these strike prices are based on that unpaid principal balance. Now, I will say this, there are a few in here that might be upside down. And if they're upside down and you're a note investor, you know that you should never base your bid off of an unpaid principal balance if the asset is upside down. So in this case, what we've developed in here is a way to identify that it is upside down, number one, and number two, use the value instead of the UPB to get the strike price. So right now it's taking a percentage of the value versus the UPB, and we'll see that as we go on further into the yields page that we developed. The other thing that's important for us is to calculate the delinquencies to maturity. How many payments are they delinquent? This is important because we want to know, are they a year out? Are they 2 months out? Are they 3 months out? This is important because if they're a year or two out, there's something else going on that's keeping them from making that payment. In this case, it could be COVID. We don't know, but there's something that's going on that we would have to identify and try to figure out if it was worth actually going into to reperform that note. The second thing is the payments made. How many payments have they made? Well, if they've only made 2 payments, they don't really have any emotional equity in the house, right? They're not they haven't nested, and they really don't have any tie to the house. So these are going to be a lot harder to get them to reperform unless their equity, which we've calculated over here, is, and let me zoom in so you guys can see. The equity over here is greater than what they owe. Okay. Now, if they've only made 2 payments and they have 358 payments remaining, this column right here is important to us because this is what we're buying. We're buying these payments from the seller at the interest rate that they gave us, which in this case, if we look at that first one, it's at 6.25, and so forth. So that's something important to keep in mind. We're buying payments from a seller that are interest bearing at a particular interest rate for a period of time. Now, most of these are at 360s. There's some, like I said before, that are at the 480s. If you see 480, it's probably because there's some kind of loan modification on it where they've added some time to the loan. And in that case, you just got to be aware of that. Now, we added this column here because we've run into situations where we're looking at tapes that are short term and they've gone past maturity. Now, if they go past maturity and they still owe money, it's important to understand what the late charges are and apply those late charges to however many months they're past that maturity mark, because that will add up and will also help you to calculate or understand what your maximum bid will be at foreclosure if you go down that road. The reinstatement amount, this is a reinstatement that doesn't have any fees associated with it. And this is very important too, because when I look at 2 payments made here, and we know that the borrower doesn't really have any emotional tie to this property, they could walk away in a second and not really care about it. But if they have equity in it, in this case, they have $631,000 of equity in it, okay, which is a lot of money, and their reinstatement amount is $23,000. That tells me that they're in a position to fully repay to fully reinstate their loan, and probably then some, if there's any fees or taxes associated with that reinstatement amount. So even though they don't have an emotional tie, they do have money in the property, which says, hey, they might be able to take money out, maybe they're able to get a hard money loan. There's all kinds of ways they can get money or take that equity out. Whether maybe they don't qualify for a bank. Maybe you as the seller or as the new lien holder can do some kind of loan modification with them that makes sense and creates a win-win for everybody. So there could be something there, but it really comes down to the difference between this equity and this reinstatement amount. And I see that there's actually quite a bit of room there. And I don't think that me as a borrower would want to lose that money. So there's some opportunity there. And then also we've created this column here to identify whether or not it's a non-performing or subperforming or a performing note. And the way we define it is a non-performing note is are delinquent payments that are 4 or greater. Anything between 1 and 3 is considered a subperforming. And then of course a performing doesn't have any delinquents. The loan age is also important for us. And sometimes this is given to us by the seller, and sometimes it's not, where we can calculate it on our own based on the information that's been presented to us. So we're always looking at that. We're looking at the loan to values. We're looking at the, now the difference between the current loan to value and original loan to value is that when the loan was originated, this was the loan to value. The current loan to value is what it is right now. Usually you want to see this lower than the original, which means they've paid some of it off. And then, and so when we do our calculations, we're always basing everything off of the current LTV. A lot of times we'll get the loan status from the seller. A lot of times we won't. I mean, it's probably a 50-50, but if we do get it, it's always valuable information because it usually tells you whether or not the borrower's in foreclosure, how many, what phase of delinquency they're in, and how you might be able to deal with them accordingly. Interest only, are any of these interest only loans? There are a few in here that are interest only, and we need to be aware of that and how to calculate those, because we're not going to calculate them the same as a P&I loan, and the yields won't line up the same. So if we are going after interest only loans, we need to understand exactly what it is we're purchasing, whether or not there's balloons on them, and what the terms of those are. So if I were to, for instance, come across this one here and we were to look at the overall term, we're at 462. That's quite a few payments for an interest only loan. So that tells, but we also see that this is a $8.8 million structure. We don't know what it is. It's a house, it's a unit, it's 4 units. We don't know yet until we go further down the line, but we do know that it's interest only right now. So what that tells me is that it's probably an investor who has an interest only loan looking to have a lower monthly payment, and they're either renting out the properties, trying to make the difference in the rent, or maybe they're fixing it up and trying to flip it, but they've given themselves 462 months or payments to cure it. Now they're $215,000 in the hole right now, and that's just for the unpaid principal balance. So, but they have 3.8 million in equity. So, this could be something to look at. This could be, if you had the money and you wanted to investigate further, yeah, let's take a look at it and see what's going on. Now, but again, you got to keep in mind what your exit strategies are and what you're looking for, because no matter if you're looking for, assets that are $1 million or above, or some that fit in a specific LTV, or have a certain loan age, or don't exceed a certain loan age, you can filter all that information out, and you can go after the ones that you're just that help you mitigate your risk for your exit strategy.
Hey, Joe, I've got a question. Gary's asking, does the current LTV and the original LTV use the same FMV, or does the original LTV use the FMV at the time of the loan origination?
It uses it uses at the loan origination, it uses that LTV, and at the current LTV uses the current value. So they're going to be different because of the valuations are either going to go up or down, and the payments are either going to go up or down. So hopefully that answers the question. Interest only, again, we touch base on that. BKs, are there any bankruptcies on the property? This is important, and a lot of sellers will not give you this information. If they don't, you can check it on pacer.gov or .org. I never can remember, but Pacer will actually allow you to search the address and find whether or not there's any bankruptcies or foreclosures or any kind of legal action associated with property, which is always an important due diligence piece to do before you actually make your indicative bid. Foreclosures, in this case, they've indicated which ones are in foreclosures, what the foreclosure dates are, or what the referral dates were, whether or not there's a forbearance on any of the loans that are COVID related. And there's not a whole lot that are COVID related, which is actually a good thing. And then we have all the information related about the forbearances, whether or not there's an ARM on some of the loans. And in this case, we're seeing quite a few ARMs. And so what this will do is it'll tell you what those ARM margins are, what the periods are, the cap rates, the floor rates, which basically mean, how much they can raise it, per period, right? So the initial period, for example, is 60. The cap rate is 1%, which they can't raise it more than 1%. There's a fixed period of 60, which they're taking the maximum of. The first rate adjustment can't be more than 2%. The floor rate is at 7.75, so they can't raise it more than 7.75. That's it. And the entire life, all the way to the full term, can't be more than 13.75%. But what ends up happening on these ARMs is it fluctuates with the market. So right now the market rates are lower, and the rates are going to be lower accordingly. And we'll see that when we get into the yields on this. So we have loan modifications. Do they have loan modifications on them? We have a few in here that are yes, and I'm pretty sure that all of these that are yes are probably more than 360 payments. So you just got to be aware of that. And then if they do have loan modifications, what's going on? In this case, they're saying that there's a deferment of interest, and it gives you a date when they were modified. So that's all good information. Again, not all sellers give you this information. You won't get this information until you've made the indicative bid and they've given you the collateral files. So don't be afraid to make a bid or an indicative bid based on seller presented information. A lot of people will try to get more information out from the seller before they make the bid, but at the end of the day, whatever the seller is giving us is what you bid on. So if they give us something that has a value on it, for example, like in this case, we have values on this tape that the seller has provided to us. Let's go to that column.
Hey, Joe, got a couple questions. Bill just said lots of ARM, but we have a question that says, when you buy a non-performing note or notes that you expect to take the property in foreclosure, do you purchase them in separate LLCs?
Yeah, if you're going to take the property back, you're going to want to put that property into an LLC. It's not necessary to purchase a note and have it in an LLC because you're not dealing with real property. You're dealing with paper, essentially. So you can have 20 notes in one LLC, and it's not going to, you don't have any liability associated with it. The second that you foreclose and take the property back, you need to get that forced place insurance. And you also, like you said, you need to think about moving everything into an LLC, individual LLC for each property. That will protect one property from the other. And a lot of people do it through what's called a series LLC. And that just allows you to set up a property within its own individual series LLC and be protected from all the rest. Hopefully that answered the question.
All right. Thank you.
So what I was saying, what was I saying before about, I was talking about the value. Oh, so these are all seller provided values. Now, let's say, for example, the seller gave us these values and they were way more than what they really are. And we've already made our indicative bid. We can come back to the seller after the fact and we can say, hey, Mr. Seller, we've done our, or Mrs. Seller, we've done our due diligence, and our BPOs came back and said, this asset is not $749,000. This asset is only worth $650,000. We're going to adjust our bid accordingly. Well, that's a perfectly good argument. And, you know, you're not going to get you're not going to be looked down on it, meaning that they're not going to place you on some kind of blacklist because you've actually done your due diligence and proven to the seller that, hey, indeed, the information you presented is not correct. So in a way, when you do make an indicative bid and you have less information on a tape, it gives you a stronger position to come back and negotiate with the seller after you've got your collateral before you fund. The caveat here is that you have to be prepared to fund if there are no issues with the loan. There are no exceptions to be cured. And even if there are exceptions to be cured, you got to be willing to work with the seller to cure those exceptions. So I'll give you an example. Let's say that there was some, the chain of title was broken, for example. If the chain of title is broken, you can go back to the seller and go, okay, part of our due diligence tells us that you need to fix this chain of title. We're missing an assignment, and we're missing an endorsement on a launch. So the seller will say either yes, okay, we'll do that, or no. And if they say no, that means you have to do it. And if you have to do it, it's going to cost you money, and then you can back your bid down accordingly. So that's kind of how it works. But let me move forward because we got a lot to talk about here. And again, please rate. Is Kanisha have her hand up? Does she have a question?
No, I think that was the first time around.
Okay. I'm just going to lower her hand. There we go. Okay. Now, this particular seller actually gives us a lot more information than most. I just want to point that out. In a lot of cases, we're not going to get FICO scores. We're not going to get debt to income ratios. And even in this case, we didn't get debt to income ratios. But when we do, we know that potentially these assets are higher end or better assets or newer assets because they have all the data associated with them, and they're easier for the seller to actually capture. Now, with all of this, what we've done is we said, okay, well, how do we dwindle all this down and start to identify the better deals that meet our investment criteria? So first off, we have taken most of the important information and put it into a yields page. And this is what our yields page looks like. So we have, you know, the identification of the actual loan itself. We have our strike price based on the same information that we had before, our 65 cents and 70 cents. And then so based on that, we are looking at our returns. What's our 1 year return on investment? And the reason why we have this in here is because sometimes there's a strategy to turn the property in 1 year. And if that's the case, this would be our return on investment. So this also has the payments made just like before, our delinquent payments, which is important, and our yield. Now this yield is based on us reperforming that note. So the faster we can reperform it, the faster this yield is going to happen. We've also put in here, you know, like for this, we have non-performing notes, so we know we're going to have legal fees. So what is that average legal fee going to be per asset? We can kind of guesstimate and be conservative, and let's just say 8,000. So we put that, well, let me put it in the legal. It doesn't really matter where you put it. They all do the same thing. But we're not going to have any closing costs because we're not selling the real estate. We're just trying to reperform the note here. So I've got $8,000 per asset in here, which actually reduced my yield when I put that in. I don't know if you guys saw that or not. But also I want to point out that this is the percentage of UPB that our strike price is at right now. And you know, when we said that we were at 65 and 70%, which is basically what we had here, you can see that that's listed here. So, you know, when I see the 70%, I know that's a subperforming note. So the payments, you know, they've only missed 3 payments, you know, right here. So I know that everything's working properly and all the numbers are actually represented correctly. Now, we have a discount. We put this in here because it's important to understand when you purchase that note at 65% of UPB, what's the actual discount that you're getting from the full unpaid principal balance. This actually tells you what that discount is. Why is that important? It's important because let's say that your strategy is like ours, where we want to purchase this asset, reperform it, hold it for a year, and potentially sell off a partial or the entire loan. In some cases with these higher end notes, you can sell a performing note at par at the blink of an eye. It happens all the time, especially the higher end ones. So if you're able to purchase a non-performing note, let's say at 65 or 70, and you have a huge discount here, that discount can be realized as additional return on investment when you go to sell your note or partial out your note. The equity is always important. You want to make sure that the equity and this whole area right here was designed to look at all of the notes together and understand the important aspects of them to make informed decisions. So the equity, understanding the equity compared to the reinstatement amount, like we said before, you got to make sure there's more equity than what they owe. Otherwise, it's not worth it for them to move forward, and it's going to be very difficult for you to reinstate. In this case, it looks like just about all of them, except for the ones that you see in red here. I'm sorry, except for the ones that you see here in red where they're upside down. In fact, even this one, the equity, where's it? Oh, yeah, this one right here is a good example of where the reinstatement amount is 11,000 and the equity is negative 22. So for the borrower, this isn't worth reperforming. So I would not even want to even consider this loan because there's nothing there for the borrower. It's going to be very difficult for you to reperform. What this is good for, if you had another strategy, let's say that you're going after upside down assets, you know that it's upside down. You have a lot of wiggle room to negotiate with the seller because the seller understands that this isn't going to sell very quickly. Not a lot of people are looking for that type of asset. So if you're basing your bid off of the value versus the UPB, you could get a good deal and you could still stay within your profit margins that you set out for yourself. So that's important. Now, LTV, one of the things that we've done here is we said, okay, we've actually created these little mouse overs that actually help me even when we're looking at these. So for instance, the LTV, we don't want an LTV that's going to be above the 80% mark. And if it is above the 80% mark, I'm going to highlight it in red. And that's what we've done here. So basically everything that's not highlighted in red is good. You know, it's below that 80% mark. The FICO scores, for example, we want a FICO score to be above the 670 mark. If it's below the 670 mark, we don't really care because we're looking at mitigating our risk. We want borrowers that have a higher FICO score that are within the right margins. Otherwise, you know, we're stepping into something a little more risky. So when we do this, all of a sudden we can say, okay, well, let's only work with those borrowers that have the FICO score between 670 and 739. Now, that's not to say you can't find a good deal anywhere else. That's just to say I'm mitigating my risk further by going with the higher FICO score, knowing that maybe that borrower is going to be in a better position to pay. Okay. Debt to income, if this is always important, if you have this information from the seller or can get it, it allows you to understand where the borrower is as far as their debt goes and how they're going to be able to pay it back, or if they're going to be able to pay it back. Most of the time when you're doing underwriting, the terms will for the debt to income ratio will vary between FHA and conventional loans. We actually get some FHA and we get some conventional loans. We get a mixture of both, but most of the time they're conventional. So those conventional loans they tend to be a little looser, but the down payments are higher and interest rates are a little bit higher. Debt to income ratio should be ideally, lenders prefer a debt to income ratio of lower than 36%, with no more than 28 of the debt going towards servicing and mortgaging or repaying the payment. So that's something that I would consider if I had that information as well. But so based on the information we have here, and me wanting to mitigate my risk, looking for something that I can reperform, I want to make sure that the difference between my reinstatement amount and my discount is high. Okay. So one of the things that I can do is I can take a look at the information just by filtering out information in this column. I can click on the filter button and I can say, okay, what am I looking for as far as a reinstatement amount that's reasonable for most people? Now, we also have to keep in mind there's assets in here that are in the millions. There's assets that are 30,000. There's assets that are 600,000. So maybe the first thing that you want to do is isolate those to get into the price range that you're willing to pay, right? So like this one, for example, is 1.4 million. This one's 750. This one's 200. It's all over the place. So maybe what you do is you say, okay, I want to look at everything below a certain number, right? I want to look at everything below, let's say 200 or 320,000. Okay, so what I'm going to do is I'm going to filter by number. I want to look at everything that is less than, okay, 320,000. What that'll do is it'll filter all of the assets that are less than that number. So now I've consolidated this to a more manageable number, and I'm in my wheelhouse now. I know I can afford these loans. Now, based on what I can afford, I can start to look at, okay, maybe the interest rates. The higher the interest rate, obviously, the more money you're going to make. But also keep in mind, the higher the interest rate, there could be more hair on the asset, meaning there could be a loan modification on it. It could be some interest-only loans that we were dealing with before. It could be a lot of things. So what I would do from here is I would come back over to my FICO scores, and I would try to isolate those FICO scores that are the 670 and above. Now, I may be looking at just, a couple of notes that I want to purchase, or maybe I want to look at, 4 notes or 10 notes or whatever. Depending on how many I want to purchase, I would adjust what I'm looking for. But right now, we're just going to kind of dwindle it down to maybe 1 or 2 notes, and we're gonna look at the best note, not necessarily that pays the best, but is the least risky, because that's what I'm looking at. I'm looking at the least risky and the easiest to reperform from the borrower. Okay, so I'm going to want to make sure that FICO score is pretty high. Now, I don't really want to touch anything that's, that's too small. So I'm gonna say, show me everything that is 630 and below. Oops, hold on. I hit the wrong one. I'm sorry, 670 and below. So show me all of them that are less than, I'm sorry, greater than 670. Because we want their FICO scores to be above 670. So there we are. We're down to a handful. Now, based on this, I can come over here to my interest rates and I can see that, this one right here sticks out, and with a higher FICO score, an LTV that is below the 80% mark. My reinstatement is $10,000, which is completely manageable. The value on the home is 120,000. Okay. I'm sorry, the value on the home is 236,000. The strike price is set at 112,000, which is 65% of the unpaid principal balance, and the yield on it is 12.5. So everything that I've explained here, if you had the right tools and you created the right environment, you could actually find or narrow down the best deal on the tape within minutes, as long as you knew what you were looking for and you knew what your exit strategy was. So the next thing that I would do is if I wanted to buy just one asset, I would come over here and I would tag it. I'd come back to my tape. I would look at that asset on the tape, try to find it. There it is right there. And I'm going to check that asset. Okay. So based on this asset, I'm going to look at some other factors on the tape that the seller has provided. So I also know that the payments that have been made are 24. So they've been in the house for 2 years. So there may be some emotional equity there, maybe not, but there is equity in this of 63,000. They owe 10, 6, and 63,000 of equity. The pricing is right because it fits within my wheelhouse. I can afford it. I can purchase it. The other thing I'm looking at right now is whether or not there's any kind of interest only on it. No, there's not. There's no bankruptcy flags. There's no foreclosure flags. There is a forbearance on it though. So that's something that we need to look into as far as what that is and how much it is, and how that's going to affect our bid accordingly. Now, we also know that there's an arm on it, and let's see what the cap is on the life. It's 13%, which is pretty high. Got to keep in mind though that most of these loans are going to refinance in 7 to 10 years. So when they refinance in 7 to 10 years, your yield actually goes up. So if you're purchasing at an interest rate of 8, 7% or lower, when you look at the time that you hold that asset before it refinances and you cash out versus the full term, which is really what we're doing when we look at these assets, we're looking at it from holding it on the full term, it changes. So one of the things that you can do when you're calculating these is you can run scenarios and look at, okay, what is my 1-year return on investment, my 10-year or 15-year, 20-year. You can look at different scenarios. You can also take a look at, if I were to sell 180 payments of these 360 as a partial, what interest rate would go to my buyer at that point, and how much could I recoup of my initial capital that I spent? And based on that information, you could pretty much pay yourself back for the note and buy another note and keep the back end or the remaining payments beyond that 180. And that's what a lot of people do, and that's how they increase their yields and returns. So keep that in mind. Now, I'm going to keep going down the list here to see if there's anything else that might be of issue. 735 is a good rating for their FICA. So this is a single family residence, and it's owned or occupied by an investor. Well, it's owned by an investor. So it's not owner occupied. So that's interesting as well. So now we kind of have a full picture. We have a forbearance that's owned by an investor, which tells us that the investor has problems paying the mortgage on this because they're in trouble. So this could be a very good deal. I would definitely bid on this. Now, one of the things I would do is I would come back to my yield section and I'd go, okay, based on my 65%, I'm at a yield of 12.5%. My 1 year out is at 20.95%. That 20.95% is if I sold this note after seasoning it for 1 year, that's basically where I'm at. So my overall yield to term is 12.5%. So the question that I ask is, if this is a closed bid and I'm in competition with other bidders, what is my rock bottom number that I'm willing to come down on my yield, knowing what my end game is, knowing what I'm trying to achieve here with this particular asset. So I could back this down and I could say, you know what, I'm going to look at maybe paying a little bit more for this just to ensure that I get the asset, knowing that I'm going to make money. I mean, I'm above 10% here, which puts me at 18% first year out. And if I were to look at the partial on it, if I were to sell that partial would probably be somewhere in that 20% range. Okay, just so you guys, so when you go to sell that partial to somebody for 180 payments, you're selling it to that investor at about 18 to 20%. That's called like a 50-50 partial. There's 25-25s, there's 50s, there's 20-20s, there's all kinds of different partials that you can calculate. But at the end of the day, there's a ton of ways that you can organize them too. In fact, you can do partials where you keep part of the interest and you're giving the investor part of it. You can do it where you're creating cash flow for both you and your investor. You can do it where you're using other people's money in an LLC or a fund, and you're giving a preferred rate of, let's say, 10%, and you're keeping the rest. So if you have a 20% partial out there, you're capturing 10% of that. So there's all kinds of ways to look at it. But at the end of the day, it's not about this interest rate right here that's presented to us, because this could be 5% and we could still make money on it, right? And that's what a lot of professional investors are looking at. They're looking at how I can create more money from nothing, basically. And that's what you're doing. You're taking the paper and you're creating more opportunity with that paper down the road. And you're doing it quicker because you're turning that asset quicker. So hopefully I was able to illustrate to you guys, how you can dial in a particular asset based on your set of criteria for your investment strategy. Now, if anybody's interested in a different type of investment strategy, whether that's a performing note or looking for, lower end non-performing notes and trying to understand what to pay for those, we're happy to do another session and kind of go over those. We have a bunch of tapes that we can bring up and review and isolate those numbers as well. But I will say this, that a lot of people are apprehensive about purchasing notes at a higher rate, especially non-performing notes, because they feel that it's going to cost them money, which it will. We already put our $8,000 in legal fees in there. It's going to cost you holding costs, which it will. There are expenses associated with that non-performing note, no doubt about it. but at the same time, there's an upside. And then if that upside has some sort of mitigated risk associated with it based on your calculations, then you can go into it with confidence and knowing that, hey, it's really hard to lose on this one. Obviously you still have to dive into some due diligence, understand who the borrowers are. You got to understand if there's back taxes owed on. There's some due diligence that still has to happen, but the idea is to identify the deal, do some more due diligence, and then make your indicative bid, get the collateral files, get your exceptions report done based on those collateral files and your further due diligence, and then have that cured, and then fund. And that's pretty much it. Bill, you had a question. Bill.
Yes, am I on?
Yeah, you're on.
It wasn't so much a question, but just someone had written in a little earlier, and Joe, I know you know this, but it's more so for anybody that's new. If you buy a non-performing note, I hear so many people just think, well, if I foreclose, then I just get the house back. And it's just not always the case. I mean, there's ways to do it. You can get a deed in lieu, you can do cash for keys. But if you go all the way to foreclosure, they just don't hand you the house back. It goes to a sheriff's sale, and then you will get back either the unpaid balance and what you paid for it, and then anything beyond that, the borrower gets. And I just always try to correct it when I see people say that. Or if you do really want the house, you might actually have to bring more money to the sheriff's sale if you do want to come back with the house. So right. I just thought it was worth mentioning that. And I know you know that, Joe. It's more so for people that were listening.
Yeah, and that's a great point that you bring up too, because I think a lot of people think that they're entitled to the equity. When they see that equity number, they're going, oh, wow, I can capture that equity. Well, even if you go to foreclosure, you're not entitled to that equity. Just like Bill was saying, you're only entitled to a part of it, which is your unpaid principal balance plus any kind of fees or taxes or legal expenses, arrearages, and so forth. But if it sells at foreclosure, you're only going to get that maximum number. And you have to understand what that maximum number is going into it. And that's why we have this reinstatement amount, because it actually helps to understand where you're at for your maximum bid. So in this case, it would be your reinstatement amount plus your unpaid principal balance, and then whatever fees or late fees associated with that and legal fees on top of it. So, that's a great point. And I think that folks a lot of times will go to educational seminars and they'll say, oh yeah, non-performing note, look at all this equity you can get. Well, the only time you can get that equity is if you foreclose and nobody bids at auction. If nobody bids on it, then you get the property back. But that's seldom. It rarely happens. And, it's a big risk. So you have to be aware of that and ready to accept whatever minimum bid that you instate. So there's always a minimum and maximum they're going to ask you at the foreclosure auction. And a lot of times people will just give the maximum. If the maximum puts you at a 15% yield and you're happy with that, then that's what you set it at. If your maximum is at a 5% yield, then you've purchased an asset that's probably not so good. But you have to understand how to calculate that. Thanks, Bill. I appreciate it.
And Joe, what can I just ask one other question before you go?
Yeah.
Are you typically bidding up to 65% of unpaid balance on all assets, or are you just bidding that high because these are higher end assets in the hundreds of thousands of dollars? Some of them.
Yeah, it's because these are higher end assets. And I will say this, that this 65% or this 75% that we have it at right now, it was sold at par. And that to me is incredible, because what that does is it puts the yields somewhere around the 6 or 7% range, which tells me that there's a lot of hungry funds out there that are willing to take lower yields with some other kind of strategy behind it. Now, you can still, based on that yield, you can still make, 10 to 12% on it if you exercise different strategies like the partials or resell the note or repackage it or whatever. But there's still a lot of work associated with it on a tape like this, and there's expense associated with the non-performing aspect of it. So whoever bought the tape at par had some kind of plan in mind and had a target on, for the yield, and knew that they were higher end and they were going to be easier to work with.
Right.
So
Hey,
they
Joe.
bought it for par. They bought it for the total unpaid balance. That's it. Or I mean, that much.
That much, yes.
Uh,
Yeah.
Wow.
I know, that's what we said. So it's happening out there. I don't think it's gonna, as we move into the future, we're gonna see more and more tapes rolling out because inventory is gonna start coming in. But right now it's tight, and they know it. And when you have deal flow that you have to deal with in bigger companies, they got to buy what they can and make what they can on them. And this is where we're at right now.
right.
Yeah, but like you said, I mean, if you're averaging, even if your 8,000 figure is high, and it's probably not nationwide, but even if you're looking at $5,000, I mean, you're still looking at substantial fees on some of them if you do have to go to, especially if you do go to foreclosure. I don't know. I just think that's awful high. That's more risky than I would get. So
Well, yeah, I mean, we could actually look at it right here.
Well, the reason, remember, Joe, we talked about this. The reason was because once they got the addresses, they knew they had a strategy, and we believe the strategy was that they were going to renegotiate based on maybe the values weren't what they were, or whatever the situation was with each asset. And so, but at the end of the day, they weren't really paying par. Remember
Right.
that?
Yeah.
So we think there was a strategy behind this for some reason, the way that was taken and the way it was paying at par, because we just haven't seen that, and that's just pretty crazy. Maybe if the addresses would have been there, I highly doubted if that would have went anywhere close to par. But what it is what it is, and stuff like this does happen now and then. But hey, Joe, just real quick, I didn't want to intervene on that, but we're running over on time. But Gina also just wanted to find out if you're going to be having a session on partials anytime soon.
Well, it's funny you mentioned that, Gina. I'm actually working on a partials calculator that might I'm going to put onto the tail end of our yields area here, so we can get an idea. I'm going to do simple calculations like 50/50s and 20/20s or something like that, just so that you can get an idea of what it would look like if you were to sell,
Right.
half of your payments or a quarter of your payments.
Right. So her question is, we're going to have a session at some point on partials so people can understand them better and how to do them.
Yeah, we will.
All
We'll
right.
do that.
All right.
Yeah.
And then it says, Sam said, is this recording going to be shared? There is a lot going on here and a lot to consume. Yes,
Yeah.
that is true. But
Yeah, we have a recording of it, and we'll make it available. The problem that I have in communicating some of this stuff is that, for people that are newer, it might be a little overwhelming. Some of the terms I'm using, maybe some of the calculations might not make a whole lot of sense, but the more that you get into it, the more you dive into it, the more you look at tapes, the more you look at what's going on, with the paper. Is it, like we saw a lot of stuff on this tape. There's interest only loans, there's foreclosures going on. We didn't see any bankruptcies, but we saw arms, and typically those arms, I'm not too scared of, because I think that overall it averages out, plus or minus a percentage or two, but it's not going to be huge. But if you understand the basics and some of the basic information that you need to make an informed decision, that's really what I'm trying to get at. And if you take anything away from this, it's that this is the core of the information you need to make that informed decision right here, what we're looking at. And there's other tools that you can develop for yourself where you're looking at those exit strategies, whether that's to reperform it, maybe even you're looking to foreclose on it and take the property back because let's say that it's 5 years out, nobody's paid. It's under the statute of limitations. There's probably no way that the borrower is going to reinstate their loan. And, depending on the situation, you may be able to go in and fairly easy foreclose. But right now with COVID, it's very difficult, and people are looking for easy ways to reinstate on non-performing, and they're looking for performing notes, and they're looking for healthy ones. So that's why these things are going for so high at the moment. But when we fast forward to the third quarter of this year to the beginning of next year, I think things are going to start changing, especially when those moratoriums lift and the forbearances start kicking in, whatever they are. I mean, those forbearances are going to be all over the board. They're going to be on the back end of loans. They're going to be in the form of balloons. I don't know how they've been formed, but it's going to affect the industry, and we're going to see a lot more inventory.
Right.
So,
hey, well, Joe, with that being said, we're running over. So if anybody has any more questions, hit us up real quick or email us and we can answer them. But with that being said, I don't see any more questions. And I think that's it then. Anything else, Joe? About tidbits or Saturday?
Yeah, if you guys are interested in our lunchtime tidbits, we've moved it to Saturdays, and we're doing it now at 10 a.m. on Saturdays in the morning. And it seems to be working. We've got quite a good crowd. We've got some very good topics. Don't know what our topic is this week. I still have to talk to Sabrina about it, but join us, especially if you're new at the game and you want to learn more about notes. It's a fantastic place to start.
Right.
So with that, I just want to thank everybody once again for coming. Have a great week, and we hope to